Well, let's welcome in Neelkanth Mishra, Chief Economist at Axis Bank now, and also the Head of Global Research at Axis Capital. Neelkanth, great to have you on this morning. So it's just feeling worse, right? Because everybody's gotten this 15% deal, including South Korea this morning, and we've been handed out 25% plus, quote-unquote penalties for doing business with Russia. Let's talk numbers first. I mean, numerically, what is your assessment in terms of GDP hit? And then what could be the second order effect? Because this seems to indicate that there is maybe a reset in the relationship equation. Maybe yes, maybe no. But your first thoughts.
Okay, so let's first quantify it. So the tariffs paid by Indian exporters when they entered the U.S. market before April was about $2.3 billion. As the 10% tariffs came in April, and then there was a 50% for all steel coming into the U.S. Starting June, the numbers had gone up to about $8 billion. So that 2.3 had become about 8. If 25% sticks, then we will be at $18 billion. So there is a $10 billion extra impact. If you were at 15, the number would have been 12. So basically you would have been, so we're talking about an increase of about $6 billion a year on last year's export numbers. And clearly now, I think, as you said, the second order impact on what happens to electronics exports, what happens to apparel exports, there was a lot of expectation that we may have an advantage at these prices or these rates. We may have a 5% disadvantage. Some of this, if these indeed stick, see, I think the message here is that even South Korea was threatened at 25%, but they ended up at 15. So maybe this is the preliminary, the pre-final step to the final tariff. And in a way, I read it as that 15% would be pretty much the floor. 25% now seems to be the ceiling. We will see the penalty, which I think is more sophisticated geopolitics, but that would be the range in which we end up settling. And I don't think it's very substantial. I don't think this is very important from a macro perspective.
Neelkanth, I'm so sorry I'm butting in because this ties in with the second part of my question, that the number and the tariff is one piece, but look at the commentary, and this is the latest quote coming in from Mr. Trump. We'll put it out. There we go. The flashes are on the screen, and look at the language. He's saying, I don't care what India does with Russia. They can take their dead economies down together. These are words from the US president. We have done very little business with India. Their tariffs are too high, among the highest in the world. Likewise, Russia and the USA do almost no business together. Let's keep it that way. I mean, these are really strong statements. Maybe this is rhetoric, maybe this is more pressure tactics, but that's what it is.
It's midnight in Washington, D.C. I mean, I think we should just ignore it. I mean, it means nothing, really, right? I mean, maybe it's just somebody's asked him something. We don't know what was asked. Maybe he's irritated, like to sleep.
Irritated?
No, I'm not joking. I'm serious.
I mean, I
don't think, look at all the other statements which have come from President Trump, right? I mean, everything has started with India is a friend, Prime Minister Modi is a friend, etc. Yeah. Of course, the tariffs are a different business, but I think we should just take it off. There's no real reason for us to sort of focus on this statement per se in that sense.
No, but Prashant, I mean, for the sake of a healthy debate, I mean, I just put the other point of view, and that's the question that I was actually, let's ask Neelkanth this.
Yeah.
That a lot of this, maybe it's just rhetoric, maybe it's pressure tactics, Neelkanth. Tell us what you think it is. But would this make investors, stand up and take note that these were these two great countries coming together to do business, but now there seem to be fissures on us buying Russian oil, us buying Russian defense equipment, us not yet saying yes to the F-35s. Is this a bigger reset? And then if yes, do markets need to be concerned?
I don't think so. What I think the markets need to get used to is what they say in diplomatic speak, an absence of binaries. That most relationships, I think, in the next decade, 2 decades, are likely to be quite complex. The thawing of relationships between India and China, for example, is also a very meaningful development that has happened. So on the one hand, I think the strategic competition with China remains intact, but at the same time, there is an access to our markets that we can provide and on our terms in return for their technology and their capital. Similarly, with the U.S., I mean, the headlines in today's papers, you would have seen, on the one hand, there was a 25% tariffs, and right next to that was the launch of NISAR, which is ISRO and NASA launching together. And from what I understand, there are very deep-rooted connections between India and the U.S. This is, we have to put this thing in perspective, that there is a $6 billion impact. I don't want to underestimate or emphasize that, this is nothing at all. There is an impact. There will be an impact on apparel. There will be an impact on jewelry. There will be an impact on electronics. But again, this is something that India needs to counter through maybe fiscal support measures, through other regulatory measures. Because what India, and if you see the Indian press release, it very clearly states that, look, we have limited room for maneuver on the agri side. I think that one of the issues not stated in the press release that even if we cut duties, the impact has to be graded, meaning over a period of time, it cannot be sudden. And those are things that India is unwilling to negotiate. Now, can there be other grounds on which common ground can be found? Perhaps yes, but I would not interpret this as a complete break of relationships, because these are strategic partnerships. President Trump is still coming in October for the Quad Summit. So, at this stage, I think the market should be best off just thinking about it as a $6 billion impact, and let's see where the negotiations go next.
Okay, all right. Hi, Neelkanth. Good to see you, Ben. What about flows? The other worry is we can quibble about, what's going to happen with regard to duties, whether or not it'll be lower or not. But the fear is that as it is, we were not getting a large chunk of the FI flows. And now, in fact, because of this sort of engagement that we're having in the United States, maybe that further moves away. What's your take with regard to flows?
Again, we have to think about individuals looking at their own self-interest. And so investors have to see India for where we are. If a very significant amount of monetary easing has happened, as of now, the economic momentum is quite weak. Which perhaps is still weakening, but with the extent of monetary easing, the economy should revive. Now, on the flow side, we've been studying this every month, and frankly, India is not an outlier. So over the last 12 months, if you see flows as a percentage of market cap, India is somewhere between 1 and 3. And the country that has got the second most, China. So if you think that U.S. and China are somehow becoming friendlier, they're not. This is a contested relationship. It's a complex relationship. And therefore, I would not think that the flows beyond maybe 1 or 2 days here and there would actually be affected substantially. They will be much more affected if the monetary easing that has been pushed out pushed by the Reserve Bank and the Monetary Policy Committee does not result in meaningful credit growth in the next 6 months. For me, the fact that the real estate cycle is stalling, that for me is a much, much more important variable than, tweets. And frankly, it's not even a letter yet. It is, I think, this is like the semi-final, pre-final that, it is stalling. Let me put some pressure. Let's get people to start, finalizing quickly.
I got it. All right. So $6 billion in terms of increased tariffs, not too concerned about flows. It's not an India-specific issue. So we got that out of the way. But you spoke about monetary policy. And now the hope is there could be some easing. What kind of action are you factoring in from the RBI? Because clearly the economy, the most data points, you get power, other consumption data points as well. It's soft. As of now, it's soft. The hope is from September onwards, we see a recovery. What role does the RBI have to play in this?
Okay. I'll take a minute to answer this. If you think about a 7% potential growth rate, you have cyclical factors on the fiscal and monetary side. In the last 2 years, as the government was doing fiscal consolidation by 80 basis points each, and it is 40 basis points this year, you are effectively starting. I know I'm oversimplifying, but I think it's very useful to think at a framework level. Your potential growth is 7, but if the government is shrinking the fiscal deficit by 80 basis points, you were starting at 6.2 in the last 2 years. This year, you're starting at 6.6. Then there is the monetary overlay. In March 2024, credit growth adjusted for the big merger that happened was 16.3%. It became 12% in March 25. and 9.8% in May 25. So there is a 6.5% point decline in credit growth. Now, given that banking system credit is about 56% of GDP, this is a more than 3% of GDP impact that we have seen because of monetary tightening. Some of it, I think, was intended. Some of it was absolutely unintended. I think the RBI ended up using very blunt tools last year, which has resulted in some of these problems. So the economy, as we speak, I think your read is right, is still weak. In fact, it may still be decelerating. When monetary easing happens, the channel through which it is most potent in India is credit allocation, meaning that financial firms need to get the risk appetite to start taking on more credit risk. As the economy is decelerating, it becomes harder and harder to do that. But still, given the extent of the easing, I think it's a reasonable assumption that there are some financial firms which still have the balance sheet, they don't have the NPAs, they can start pushing through. And once the first 1% point increase in credit growth starts to happen, which is, I think, maybe November, December timeframe, the economic acceleration after that should be quite substantial and very, very rapid. That's our opinion.
That sounds very, very reassuring, just the kind of reassurance perhaps one needs, Neelkanth. And, I was just coming to exactly that point. So you're saying October, November onwards, the acceleration should pick up. So let's just, understand what you're baking in right now. How many more rate cuts? What kind of a pickup in GDP growth? And are you factoring in anything more from the fiscal side? We've already got that income tax cut. Is there anything else that you would expect or, at least wish that the government considers?
So on the monetary side, see, there is prescription, there is prediction. So prescription for me is that nothing more needs to be done for now. Because remember that the channel through which we are expecting monetary policy to act is not the cost channel. So we are not saying that if you make loans 50 basis points cheaper, credit demand will accelerate. Because the challenge here is risk aversion in the economy, risk aversion in the regulators, risk aversion in the financial system. Just to give you a sense of what I'm saying, back in 2013, nearly 60% of bank loans were at interest rates above 12%. And I totally get that this was a high inflation environment, that things were growing faster and all that. But that was the level of risk. Today, it is less than 11%. In the last 1 year, the incremental share of 10% plus interest rate loans has collapsed. So it is about, so when the problem is risk aversion, I think rate cuts are not going to help. So I think what you need is much more, I would say, procedural changes, and which we can discuss when we have more time. But on the fiscal side, I don't think there is much room. In fact, what I apprehend or what I'm apprehensive of is that in the next couple of months, there may be market concerns emerging that tax collections are falling short. Remember that these things are all very cyclical, they feed on themselves. But hopefully that will be temporary. I don't think the government intends to miss its fiscal target. So if it means there may be more disinvestment, there are other tools available which you can use to sort of meet the targets. And so fiscal, I don't think there is room. I don't think there is even intent to change this. I think the government is likely to wait for the reduced cost of capital, that the 10-year bond yields are low, the equity capital is cheaper, and let entrepreneurs then do their thing. So I don't expect anything to happen, but I do expect that with a lag, the monetary easing should lead to greater credit risk appetite for borrowers. And I think demand is there. I mean, most people say, oh, there is monetary easing, but where is loan demand? In an economy like India, credit demand is always ahead of credit supply. If you see some of the NBFCs lending at 28% viably, it tells you that that the demand for credit is all there. It is a question of when the financial firms and the regulators become much more comfortable allowing firms to take credit risk.
Yeah.
All right, Neelkanth, thank you very much for joining us. Good speaking with you. And as you said, we'll invite you over for a longer discussion, but I think very, very useful, very insightful as always. Thanks indeed for being with us here on the program.